Hey there, and welcome. Today, we're digging into a document that really makes you think about a common financial safety net, that life insurance you get through your job. It argues there's a hidden truth we all need to understand. Let's get right into it. So, let's start with the big question this document throws out there. Is the life insurance you get from your employer really enough to protect your family? A lot of us see it as a fantastic perk, but is it the complete safety net we think it is? You know how it is. You see that benefit listed in your job offer and you think, great, my family is covered. But the document we're looking at today makes a pretty bold claim that this belief might be totally misplaced and it might be creating a false sense of security that could leave your family exposed when they need it most. And that brings us to the first major idea from the source, this whole concept of a false sense of security. It feels solid, it feels permanent, but at the end of the day, it's based on something that's totally temporary, your job. The source uses a really powerful analogy here. It compares employer insurance to renting a house. Sure, it feels secure while you're living there, but that protection isn't actually yours. You don't own it. The second you leave that job, for any reason, that security can just vanish. So to build its case, the document breaks the whole problem down into 5 specific issues it calls hidden gaps. According to the source, these are the weak points in most work insurance plans that can create some major risks for a family. Let's take a look at each one. All right, first up, we've got gap number 1. This is the big one. The policy is tied to the job, not to you personally. The source really hammers this home. At the exact moment your family might be the most vulnerable, say during a layoff or even a planned career change, the coverage is just gone. No grace period, no options. It just stops. Okay, the second gap is all about control, or really the lack of it. Think about it. The document points out that your employer is the one who decides how much coverage you get. It's usually just a simple multiple of your salary. But is that number actually based on your family's real needs? Your mortgage, your kids' future college costs. The source says, probably not. And that lack of control leads us straight into the third gap. You have absolutely zero say over the policy itself. You can't customize it, you can't add specific protections, you can't lock in your rates. The entire plan can be changed or even completely eliminated whenever your employer decides. This fourth gap? It really speaks to how we all work these days with our modern mobile careers. As you can see here, when you switch jobs, that old coverage ends and you have to start all over again. That creates a potential gap in protection. And what's worse, if your health has changed since you started the last job, you might find that new coverage is way harder or way more expensive to get. And the fifth and final gap, this one is absolutely critical. Here's the thing, that work policy, it typically only covers the employee, you. It often doesn't account for your spouse's income or contributions, and it usually provides no coverage for them or your kids. That leaves a huge part of your family's financial picture totally vulnerable. So, after laying out these 5 gaps, the document shifts its focus. It starts talking about the consequences of just relying on this kind of coverage and, well, waiting. It frames this not just in dollars and cents, but in pure risk. And wow, this chart from the source material is pretty eye-opening. It shows the estimated monthly cost for the exact same amount of coverage at different ages. So at 35, it's about $25. By 45, it nearly doubles. And then at 55, it just skyrockets to over $120 a month. To put a single number on that, the document calculates a staggering 380% increase in premiums over those 20 years. The message is crystal clear. Waiting has a direct and really significant financial cost. But the cost isn't just about the money. The source lists these other risks that just pile up over time. Your health could change, right? That could make you way more expensive to insure, or maybe even uninsurable. Your family's financial needs get bigger, and as we've already seen, your employer's plan or even your job itself can disappear without warning. Okay, so after painting a pretty detailed picture of the problem, the document pivots to what it presents as the solution. This slide really lays out the whole argument with a super clear comparison. On one side, you've got employer insurance, which the source describes as temporary, not portable, and one size fits all. On the other side is what the source calls direct insurance, a policy you actually own yourself, which it defines as permanent, portable, and totally customizable. And this image, it just captures the feeling the document's trying to get across. It's about owning a policy that creates this permanent shield of protection around your family, one that you control no matter where you work. So, what does the source actually suggest you do about all this? Well, this final section outlines an actionable plan for, in its own words, protecting your family's future. It proposes a pretty straightforward four-step process. First, an analysis to figure out the real amount of coverage your family actually needs. Second, exploring the different kinds of direct insurance out there. Third, taking action to lock in a good rate while you're younger and healthier. And the final step it suggests is just the peace of mind that comes with knowing you're truly covered. The document we've been exploring wraps up by providing the name and contact info for its author, Mahinder P. Talani, for anyone who wants to follow the steps that were just outlined. And that's where the source material comes to an end. So, we'll leave you with the one central question this entire document is built around, bringing back that initial analogy. Is renting your family's security, as the author puts it, a risk you're really willing to take?